Welcome back. Let's talk about markets. Jyotivardhan Jaipuria, founder, MD at Valentis Advisors, is now with us on the show. Jyoti, you've been cautious in the markets for the last 1 to 2 years now. But do you think the tide is turning now? There are reasons to be optimistic from here on. And can equity markets give returns? Because up until now, whenever we got a guest on board, he indicated that in 2023, do not expect much by way of stock market returns. Do you think that will change? And this could actually turn out to be a good year in terms of returns?
Yes, Liba. So like you said, we've been very cautious last 18 months. But there's some positives which are emerging now. So the first is interest rates. So as you know, last 12, 18 months was all about interest rate hikes. We've seen RBI pause. It was like probably the first major central bank to pause. We'll probably see a lot of the other US Fed and probably the European banks also pause somewhere over the course of this year. I expect Fed to pause, probably in the May meeting. So that I think could help, better equity returns. There is, of course, one of the concerns about a slowdown, which will be plaguing equity markets this year. But I think, like if we look at the next 12, 18 months, I think we'll get a positive return. We probably could end up with like a double-digit positive return next 18 months or something.
Jyotivardhan, hi. Good morning. This is Surabhi here. So I think, people are trying to sort of place their bets looking at the elements that lie ahead. There seems to be a consensus trade that IT is not going to really make you money this year. Stick with banks is what one constantly hears on the street. How are you cutting it up? And in the midst of all this is the consumption piece, because there's the monsoon and the El Nino sort of joker in the pack. So just tell us your approach as you're looking at the first half of this new fiscal.
Yeah, so Surabhi, we had like two simple themes for the last 1 year, and we still stick to that. One was buy domestic plays and avoid the global plays. So, IT was something we've been negative on through the last 1 year. Second is we've been more preferring the Indian investment theme rather than the Indian consumption theme, because the consumption is still expensive and, consumption on the margin is slowing down. So, we continue to stick to both these themes. So now, it's not as easy a trade as it was a year ago because, as we know, IT is underperformed quite a bit. The reason we still continue to stick to this is, there's still a lot of uncertainty about the future outlook of the IT companies. As you know, there's been a lot of layoffs in the banking space, in the tech space in US, and that I think will cloud the earnings outlook for the companies here also. The guidance will be tough. I don't think companies have enough visibility to give our guidance. So at the moment, we are sticking to, being underweight these names, though, just the stock performance makes us a bit more cautious and looking at them closely for any sign of turn.
Okay, got that. Thanks for joining us. What are your thoughts on the entire real estate space? We're getting the pre-quarterly updates coming through, looking extremely good, across the board. Is this a space that you think is good to get into now? Especially with interest rates also coming down?
Yeah, so Pavitra, there are two ways you can play it, right? You can play it through the real estate companies themselves, or you can play it through what I call the ancillary to the real estate, the tile companies, the wire cable companies. So we prefer playing it through the, ancillary space rather than the real estate companies directly, because, a lot of the real estate companies have high debt, and that's something which we are always very cautious of. So we think, playing it through the ancillary space is better. The other headwind or other tailwind which is helping the ancillary space is that the raw material prices are coming down. So if you think of tiles, gas is the raw material, the prices are coming down. If you think wire and cables, a lot of the metals prices are coming down. So they are benefiting from two things. One is they are benefiting from a strong real estate growth, which helps their demand outlook. The second is they are benefiting from the fact that their margins last year got squeezed because of huge commodity price increases. That is reversing. So we'll see margins normalize, we'll see margins going up again, and that will help also the ancillary companies. So we think those are better plays than really the real estate companies directly.
Earlier today, Jyoti, we had Motilal Oswal telling us how they've gone ahead and raised the consumption they've raised the overweight on their consumption basket by 200 to 300 basis points. And they're saying that even if there is an El Nino, even if there is deficient monsoon comes out to be 94%, it's not such a big deal in terms of the impact that it's going to have on consumption per se, because we've had a couple of good monsoons. The reservoir levels are pretty comfortable. So they're not too worried on consumption. In fact, they've gone ahead ahead and up their weightage. Where I know you said that, on consumption, you're not very confident right now. You're a bit cautious. But can you, throw the converse argument to what Motilal Oswal had to tell us?
So, for us, it's not so much the El Nino, because obviously El Nino puts a bit of question mark on the monsoon. But, we've had many periods where with the El Nino, the, agriculture output has been good, and the converse also is true with, where we had La Nina and we still had a very poor agriculture output. What, for us is we are always weighing the evaluations. And for us, at these valuations, it still is probably not attractive. We don't find too many attractive plays in the consumption space. So, what we like is, like I, was telling Pavitra, we like some of these ancillary to housing companies, let's say the tile companies, the wire cable companies, which are also consumption plays in some sense. And those are stocks which look attractive. But I guess when you're talking of, consumption, you're talking of, the traditional FMCG companies, those still look very, very expensive to us for the growth that they are delivering. What we'll have, like, you go back to 2003 to 2008, we had a lot of the infrastructure type, capital good type of companies do well because, they were coming off a very low base. Same thing here, you're coming off a very low base on earnings for a lot of these investment-led companies. And so, you can see earnings growing much faster than the consumption names for them. So, and they are much cheaper on valuation. So that's the reason we are more focused on actually CapEx rather than on the consumption space.
Okay, you led me to my next question, Jyoti. Actually, I was just coming to CapEx. Reading a report, quite interesting, that actually road ordering has been lower this year. NHAI hasn't been able to complete all its ordering, and there should be some spillover in the first half of the new fiscal, apparently. But then ordering, we know, defense, for instance, railways, has just been really blowing through the roof, right? So how exactly are you playing CapEx? Through what sort of companies?
Yeah, so, so if you just think about it, what the government has done is CapEx as a percentage of GDP spend is going up constantly from the government. Conversely, the non-CapEx, which is the consumption part, is going down. So ultimately, we are focused on stuff which is relying on government CapEx to really do well. At the same time, there's some fleeting signs that even the private sector CapEx are going to come in. So we are playing it to 2-3 ways. One is we are playing it through a lot of these pipes and companies which benefit from this Har Nal Jal program of the government. The other is we are playing it through capital good names, which is like really people who are benefiting from the first leg of CapEx happening. Some of them is going to defense, some of them is going to railways, some of that could be going to general industry. The thing which we are avoiding is like a lot of these road names. We don't like generally all these EPC contractors because they supply directly to government. Their working capital normally is very stretched, and so the balance sheets get messed up quite a bit. So that is the part which we avoid. We prefer playing capital goods and ancillary companies there.
All right, got that. Just one final question. What is the kind of overall earnings growth you're factoring in for Q4, since we're just getting into the season this week?
So Pavitra, Q4, I'm looking at Nifty earnings growth being close to 15%. But what I must warn you is a lot of this is skewed by banks on one side. Banks account for a lot of the growth. And obviously on the negative side also, they're getting dragged down quite a bit by the global commodities. So there's quite a bit of skew. Otherwise, some of these other things are doing well.
Very, very quickly, is defense still attractive in your local theme? Because stocks have run up. So are the valuations still comfortable?
So, Reema, like pure defense companies, I think they will pause in terms of share price performance, at least, because we have a lot of order book and the stocks ran up along with the order book. We now need to see the execution. But what that is also leading to is there's a second rung of companies which supply some components to these people who are now, who have not run up as much and they are much cheaper. So those are the things which we are looking at. So I would say ancillary to defense also.
Got it.
All right. Great talking to you, Jyoti. Thank you very much for joining in, and we look forward to our next call.